Hey everyone, Dan Kane here with the Seed Planning Group. Welcome to our SweetK YouTube channel. Our SweetK team is dedicated to helping you with your employer retirement plan by providing you with education and a point of contact for any questions that you may have. This channel will be used to post a series of videos specifically for you. Today I'm going to talk about the different investment options commonly available in your retirement plan and the differences between those choices. So let's go ahead and get started. The first question we want to answer for you is what type of investment options are available to you in your workplace retirement plan? When it comes to your employer retirement plan, the main investment option you have to choose from will be a mutual fund. So let's dive a little deeper into what a mutual fund actually is. A mutual fund is an investment vehicle that allows you to mutually pool your money with other investors. This type of investment vehicle allows investors to contribute small amounts of money on a regular basis, and you still have access to a professional money manager who manages the investments within the fund for you. Not all mutual funds are created equal, and we'll explore the differences between the most common types of mutual funds that you'll see in your retirement account. In most workplace retirement plans, there's usually two ways to choose the investments within your account, and it's really dependent upon how hands-on or how hands-off you'd like to be when choosing those investments. The two choices will consist of a target date retirement fund or a preset lineup of mutual funds that you can choose from. So let's first talk about how a target date fund works. Think of a target date fund as a collection of mutual funds that are packaged together to create a well-diversified fund for you. When you look at your fund lineup, and if you see a fund that says the year, say 2025 or 2055, if it has any year next to it, that is an actual target date retirement fund. These funds work by changing the investments within them as you approach the target year that you choose. For example, if you chose the retirement target date 2025 fund, as we approach the year 2025, the fund manager within that fund will slowly change the investments within that account. They will generally become more conservative by reducing the exposure to stock mutual funds and increasing the percentage of bond mutual funds within that specific fund. So essentially, as we get closer to that specific date, the more conservative that fund will be, and the further away we are from that date, the more aggressive that fund will be. And when I say aggressive, what I mean is a higher allocated percentage of stock mutual funds within that account. The way to choose these mutual funds is to pick the fund based upon your projected retirement year. So if you plan to retire in the year 2030, you would pick the Retirement 2030 fund. If you're unsure exactly when you're going to retire, you can choose a fund closest to the year that you turn age 65. And of course, if you leave earlier or later than that, you can always adjust by changing the investments that you're in. The second way that you can invest within your employer retirement plan is a more hands-on approach to investing, where you will choose your own collection of mutual funds set from a preset fund lineup. With this approach, you are controlling exactly what types of funds are in your portfolio, and you are responsible for making any of the necessary changes to those investment choices as well. Let's talk about some of the most common types of funds that you can choose from. The 5 most common categories of mutual funds are listed here, and we'll briefly go through each one and explain the differences between them. The first one we're going to talk about are bond mutual funds. So a bond mutual fund is a collection of bonds, whether that be corporate bonds or government bonds, and those are packaged together within a specific mutual fund. First, everyone should know how a bond works. With a bond, you are agreeing to loan a corporation or a government entity money, and they're agreeing to repay you back your original investment plus interest along the way. Bond mutual funds are generally less volatile than stock mutual funds and tend to have an inverse relationship with stocks. Not all the time, but they do tend to. Bond mutual funds may consist of just one type of bond, or there may be a combination of different types of bonds, such as corporate and government bonds packaged together. Now, let's talk about stock mutual funds and the most common types that are available to you in your retirement plan. The first type of stock mutual fund I want to talk to you about is a large cap fund. When you hear the term large cap stands for large capitalization. We're talking about large U.S. companies with market capitalizations of $10 billion and above. So these are the big ones. When you hear the term blue chip stocks, they're talking about large cap companies. These are the really well-known, a lot of times well-known companies, your Apples, your Amazons, your Googles. your Walmarts, the huge companies. These companies didn't necessarily start out as large cap companies, though. They started from the ground and kind of built their way up. So let's talk about where these companies have come from. So large cap, think of those as your big companies. Now we'll get into some smaller companies. So the next category of mutual fund I want to talk about are mid-cap stocks. So with mid-cap stocks, you're investing in medium-sized U.S. companies that have market capitalizations of around $2 to $10 billion. They're still very big, but not quite at the blue chip stock level that we just spoke about. These types of mutual funds may be slightly riskier than large cap funds because they're not as big and not as well established. But there is actually another type of U.S. mutual fund that I want to talk to you about as well, called a small cap fund. Small cap mutual funds invest in U.S. companies with market capitalizations of less than $2 billion. These companies are potentially riskier than large and mid-cap funds due to their size. However, these types of companies may have more upside since they aren't as well established and can potentially grow into medium or large size companies in the future. The last type of mutual fund we're going to talk about today is going to be your international stock fund. International stock funds, as the name implies, invest in companies outside of the United States. There's many types of international mutual funds, but today we'll focus on two different groups: your established market mutual funds and your emerging market mutual funds. Established market international funds invest in companies within more established markets, meaning these countries have a more modern economy and a higher standard of living than emerging markets. Your emerging market funds invest in companies that are located in countries that have some, but not all the characteristics of an established market. These countries are becoming more incorporated into the global economy and transitioning into a more modern economy with a higher standard of living. Out of all of the mutual funds we spoke about today, international mutual funds carry the most risk out of all of those choices. So if you've listened in today and you're still unsure if you want to be hands-on or hands-off with choosing your investments within your employer retirement account, reach out to us and we'll be happy to guide you along the way. Visit 401ktime.com and click on the Contact Us button in the top right-hand corner. If you fill in your contact information, somebody from our team will reach out to you within 24 hours to schedule a time to meet and to help you with any questions you may have regarding your employer retirement plan. Please don't hesitate to contact us and reach out to us, and thank you for listening in.